I mean, everyone's here at college. I mean, is it cheap for you to go to college here? It's really just, no. It's expensive. Education is really expensive, okay? So if we look at everything that this country has gone through and all these people have gone through as education, and at least, you know, we all know education's expensive, so okay, it was an expensive education. At least we learned something from it. Then you're like, okay, you know, it's expensive, but at least we're not going to do that again. But here's the problem is, I don't think anyone's learning. I think we just wasted that money. I think we just wasted, you know, all these people having to go through this, because I think we're getting okay with foreclosure. And you know, what you're saying is a lot of people made a lot of mistakes. And one of the things Joseph said is, what can we be careful of? Well, this whole thing began as what we called the subprime crisis, which was subprime means less than optimal. So if you're a subprime borrower, that means that people consider you a not so great borrower. You got bad credit, you don't have a lot of money, you know, that kind of stuff. They were putting people into subprime loans, and it was mostly Hispanics and African Americans, and it was mostly lower income people. And it was, a lot of it was through churches, you know, people that, you know, they were sort of predators, predatory lenders, and they would find someone that you trusted in the community and create a relationship with them and sell you these crappy loans. And it wasn't like, you know, you say, oh, you know, I want to buy a house, I'm going to go online, I'm going to ask for referrals, I'm going to find a mortgage person. These guys were knocking on doors. They were sending older people and poor people, they were sending people mailers. They were knocking on doors to get business, to be very aggressive about it. And a lot of those people, that's really where the crisis started, is when those loans, which started at maybe, you know, 1% interest rate, but then had this fine print clause that jumped it up to a 12% interest rate, those loans started going to default when people couldn't pay them, which, on a side note, is something I find incredibly empowering for people in this country, is that, you know, our subprime borrowers ran into problems, and all of a sudden they had guys up on Wall Street having to change their diapers because they were so freaked out. And that speaks to the power of Main Street. I mean, that speaks to the power of the American people when, you know, the poor people stop paying and the rich people are really having a hard time with it. It then bled over into other things. So, you know, one of the things that you want to be careful of is that you don't sign up for something that you're not going to be able to afford to pay. I mean, people assumed home values would keep going up. So they would buy a house and say, well, you know, I'll just refinance this in 2 years when the rate goes up because home values are going to keep going up. That's a bad assumption. I mean, you have to always assume the worst. You hope for the best, you assume the worst. These are things our grandparents knew. After that, though, it did become, you know, a situation where unemployment caused people to default, and now, of course, we have people who just don't want their homes anymore and they don't want to pay. So you raised an interesting point. I mean, there's people on both sides that are very passionate. I mean, there are people who are current in their mortgages who are pissed off. They're pissed off at those people who aren't paying and those people who are trying to get modifications and think they're entitled to this or that. And they're saying, I don't want to pay for you. I don't want to pay for your foreclosure. I don't want to pay for your mortgage. And they're very passionate about it. And then you've got the other side of people who are truly suffering, people who were duped into a mortgage. I mean, ultimately, I think that ultimately you all are personally responsible for yourself. I don't think it's up to the mortgage broker to be responsible for you. You got to pick the right guy. I don't think, you know, if we can regulate them till we're blue in the face, I can't protect you from everything. You got to protect yourself too a little bit. But, you know, you've got people on that other camp who are saying, you know, we were screwed. I mean, we were completely ripped off. These banks knew what they were doing. They were all making money off of us. They put us in these bad loans. And they're very passionate about it too. And there are people who are sitting outside the bank presidents' houses protesting and following their kids to school. I mean, it's really bifurcated, you know, our country. And the people on both sides of that are angry at each other. So you're right. Well, let's talk specifically in Florida, because I said Florida is a recourse state. There are some states that are non-recourse states, like Arizona, for example. You can walk away from your mortgage and the bank can't come after you for the balance. The advantages, you know, would be if you really just are not ever going to be able to recover from this, and you just need to get a clean start. You know, I tell people all the time, I must get 100 calls a week from people, and if there's really no other alternative, you just get the pain over a lot quicker. I mean, it's like coming clean on anything. You know, that's the biggest advantage. The disadvantages are the deficiency judgment and the hit to your credit report, of course, which we all know if you have bad credit, that's going to end up costing you more for a long time. It depends on the type of mortgage, too. If it's a Fannie Mae or Freddie Mac mortgage, they now will allow you to buy again sooner if you do a short sale or a deed in lieu. Does everyone know what a short sale or a deed in lieu of foreclosure is? Have you ever heard of those terms? Okay. A short sale is if, like we said before, you owe the bank $300,000, your house is only worth $200,000, you find a buyer for $200,000, and you go to the bank and you ask, look, I know I owe you $3, but if I can sell it for this guy for $2, can I do that deal? And the bank will say one of two things. Either they'll say no, or they'll say yes, but we still want you to come up with the other $100,000 somehow. Or they'll say yes, and you don't have to pay us that other $100,000. So that's a short sale. A deed in lieu of foreclosure is when you go to the bank and you say, listen, you know, I can't pay the mortgage. You're going to have to foreclose. Rather than pay and lose that $80,000 foreclosing, why don't you just let me give you the deed to the property and we'll call it even. And the bank will either say no, or they'll say yes, but you have to pay us, you know, the difference between what we can sell the house for. Or they'll say yes, and you get to just walk away. So, you know, nowadays the deed in lieu and short sales are becoming so popular, and the banks are getting just more comfortable with that, way more comfortable than with the modifications, that, you know, it's unusual that someone really has no choice other than to walk away. Most of the banks that I represent are now keeping those deficiency judgments, and their strategy is just to wait. They're just going to sit and wait, and they will wait until the borrower forgets that it exists, if they have to wait for 10 years, and eventually they're going to try to collect on it. We are going to see a lot more bankruptcies. 5 years out from now, we're going to see a lot of bankruptcies because it's the only way people are going to be able to get rid of these deficiency judgments. We're also going to see a lot of banks selling the judgments because they're going to have so many to these very aggressive collections firms. Has anyone ever had to deal with a collections firm? It's really horrendous. It's a nightmare. And a lot of people that you know will have judgments and they'll be sold to collections firms, and it's a nightmare. What do you guys think? Should homeownership be a fundamental right?
No.
Well, that's a really interesting question, because one of the things that they're looking at in Washington, and this will impact you as first-time home buyers, is what kind, you know, the government is behind most of the loans nowadays. One of the things they're asking is, how involved should government be in home finance? And that goes to how much money you're going to have to save up for your down payment. Right now, you can get into a house for a couple of percentage points, but a lot of people in Washington are lobbying to increase that, to not let you be able to buy a home until you save 10 or 20%. I mean, that's what they do in Europe. You can't buy, you know, you can't get mortgages as readily as you do in this country. Also, to not give home loans to someone who doesn't have a good credit score, you know, or who has had a bankruptcy or who has had a foreclosure before. So right now, it's not part of our Constitution. It's not a fundamental right, but, you know, home ownership is an important part of everyone's life. Now, one of the things that, you know, we have been talking about with some of the congressmen is adding a provision to the FHA loans, for example, that says, because here's how I feel personally. I'm happy to use my tax dollars to help you or anyone buy their home. But if you're going to use my tax dollars to buy your home, I want to make sure that you do put a little bit of your own money down, but also that you don't refinance that home next year and get all the equity and the cash out. Because there's the 8 reasons that we went over before are the reasons that I want everyone in this room to own their own home. I want them to be able to save money for retirement. I want them to have their own safety net in case there's a divorce or unemployment. I don't want to have to pay for that. You know, if God forbid you're unemployed next year, I don't want to have to pay for it. I want you to have your own home equity to be able to do that. But with the FHA loans now, you know, someone can borrow my tax money from the government to buy a home, and then next year when the home goes up in value, they can cash out all that equity, and that's not why I want them to have my money. So it's an interesting question. It's up for all you guys to decide. But those things will be decided in the next 2 or 3 years. It's a good question. What do you guys think?
If you have equity.
Yeah. I think it's yeah. Wait, someone said it's cheaper than what? It's cheaper than what? Yeah. I think it really depends on your own personal circumstances and where you want to buy. You know, there are real estate indicators, which we also talk about on the website, which everyone can look at that are released on a monthly basis that tell you sort of what's happening with the market. Generally speaking, I would not be afraid to buy in this housing market. I think in Florida, prices are going to go down a little bit more. But, you know, you're right. I mean, we still get good values. You know, one of the problems we had is that we went away from traditional real estate valuation methods. You know how when you drive a car off the lot, it's worth less, but you can look it up in the blue book and that's how you know what your car's worth? Well, in real estate, we have different ways of valuing. One of them is called replacement cost. So we know if it would cost $1 million to build this building today, then the building's worth at least $1 million, because if you want the same thing, that's about what it would cost to build it. You know, there's other factors like depreciation, but that's just, you know, roughly speaking. And those valuation methods still work. So generally speaking, I think you look at replacement cost, you look at the comps, you know it's going to go down a little bit, but you compare it to your own circumstances. Banks are in a very interesting position now, and not all banks are in the same position. But you know, my personal feeling is, and I work for banks, is that, and this is not my clients, it's just everyone else's clients, that there are problems at banks that we're not aware of, that they are in a lot deeper doo-doo than most of us realize, than they have admitted. They're not lending money, and they're not lending money because they're afraid of the risk. And in the meantime, you know, so that shows us, I mean, I don't want to get too complicated, but the government has certain tools that they can use to try to address a problem like this. The problem is that those tools were created, bless you, those tools were created after the Depression. And the problems in the world is very different. I mean, it would be like buying a house that was built in 1935 with all the modern technologies, and it was awesome. And ever since then, they kept doing this addition and that addition. And I mean, that's basically what our government has done, and the rules that started after the Depression. And they just don't work now. For example, lowering the interest rate. That's one of the things that the government has done, made money more available to banks by lowering the rates. The problem, and also theoretically to Americans, if you want to get a mortgage now, how many people have heard how low the interest rates are on mortgages now? Problem is, with a 620 credit score, which is what most people have now, you can't get that rate. So, you know, the tools that the government had don't work in this situation. Yes, there's a lot of things that need to be reworked.